Welcome to the Facts vs. Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese. Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. And we are back. Episode 146, Carson's Facts versus Feelings. Ryan and Sonu here. Sonu, we're calling this one Au Revoir, Trade War. But before we go there, on the YouTube channel, I'm not sure, do you have some of those new denim jeans sponsored by Sydney Sweeney that came out last week, pushed that stock higher for, what is it? It's American Eagle Outfitters. Did you buy jeans because of Sydney Sweeney? I have to ask.
I don't own a single pair of jeans right now, and I haven't worn jeans for years now. But
so you're not their demographic.
I may be in the market for one though. I shouldn't say anything else. I'll just get myself into trouble here if I say anything else.
Yeah. Well, yeah, I thought that was, we talked about meme stocks last week and it's still going. We probably won't dive too much into it, but American Eagle Outfitters was the latest with Sydney Sweeney, apparently. I did see she was in some movie. I think it was called Immaculate. It was one of those, I don't know. It was like a nun movie. She gets pregnant. It was wild. Anyway, I never knew who she was until about 2 months ago. Apparently she's popular because she had that stock go up night. So old we are. All right. Well, listen, we always have a ton to discuss. There's a lot we can start with. So I think you and I are kicking around the idea of starting with some, what do we want to call them? Falsehoods? That's a strong way to put it.
Market myths?
Three market myths. Let's start with three market myths we've been hearing about.
It's always something.
There's always something. Always trying to scare us. Oh, by the way, before we even go there, so we're doing this Monday afternoon. Did we close up or down today on the S&P? What did we miss it?
Literally two.
Well, I know that's what I'm getting at. Was it up or down though?
Up 2 basis.
So technically, okay. So
the S&P 500 is up 0.02%. This is Monday, July 28th.
Listen here, mister. It's like a little bit pregnant. That's an all-time high, okay? I mean, that is the sixth.
An all-time high?
Yeah, well, if it's up 2 basis points, sure, whatever. Yeah. Okay, it counts in my book, you know?
All right.
So that's six all-time highs in a row. We were higher 5 days in a row last year, every single day higher for the first time at an all-time high for the first time since November 2021. So you could argue the old saying, don't short a dull market. It is as crazy as it sounds. This is kind of dull because we're barely moving higher. But listen, all-time highs.
There's truth to that, right? Yeah. Don't short dull markets. And I feel like last 2 years, we've talked about this. Summer tends to be low volatility periods.
Yep.
And you don't want to be short them, just ride the market up.
Yeah, exactly. So some of the myths we're hearing, excuse me, clear my throat there. Three of them. The first one I want to talk about is the idea that market breadth is poor. I don't know where this is coming from. I want to start off with that. Our good friend Jeff DeGraff at Renmac has said something very similar. Just last week, we had the S&P 500 equal weight index make a new all-time high. That is equal weight, okay? So it's not like just a few stocks are pulling it higher. That's a good thing. Also, as you noted this morning on a morning call we did with our Carson partners, our Carson advisors, all 11 sectors are up on the year. Yes, some are up more than others. Spoiler alert, every year, some sectors are up more than others. And then you look around the globe, you have various indices around. I mean, Japan, first new high in 35 years. Okay,
that's incredible.
Most stock markets hitting a 52-week high or an all-time high. Like as we talk about this, then lastly, advanced decline lines across the board are making new 52-week highs or all-time highs. So to me, Sonu, I don't want to say anything other than I don't know where this is coming from. That this is not this is a broad-based rally. What do you want to add to that?
No, I think between the equal weight and all the sectors being in the green. And especially a sector like industrials.
Yep.
S&P 500 industrial sector is up about 18%, something like that. This was as of last Friday, so 25th of July. I mean, it's not often industrials race ahead of the main index, ahead of the S&P 500. But this time it's up, it has. And industrials is a really broad sector. It's got everything and anything. It's got, Boeing and Caterpillar and all of it, right? And that just tells you that there's strength across the board.
Well said. So that's one myth that we just busted. We're going to bust another one. And on the YouTube channel, David, I just sent this. Oh, you know what? I sent it to the wrong Teams message. I sent that to Maria. I sent this to Maria, who helps with our events. She's going to have no idea what I just sent her. It's a chart of margin debt. Sorry, Maria. We're going to have to apologize to Maria. It's been a long day. Sonu and I are talking about this. It's been a long day. But anyway, on the YouTube channel, we're hearing a lot, Sonu, about margin debt. It just cracked $1 trillion, 1.0008, or maybe it's 2 zeros or 3 zeros, 8. $1 trillion, similar to credit card debt. Yes, it's a record, but you have to talk about the denominator. Before I go there, I'm going to send this, David, to the correct Teams message. What is margin debt, and why is everybody freaking out about it?
So margin debt, the data comes from FINRA. It is basically how much people are borrowing to buy stocks or to buy anything, really, or even short stocks. And that gets to the idea that, yes, people may be going into debt or borrowing within their investment accounts.
Yep.
But that could be to buy more stocks. It could be to go short stocks. It could be to buy inverse ETFs. I don't know. I mean, it could be any number of things. But generally, you see margin debt continuously go up, and it should. Why? Because the stock market's going up. So something you've always pointed out is denominator blindness, right? And with respect to, when we talk about credit card debt, you have to talk about what is the total amount of debt. How can people service it? What is credit card debt as a percentage of, say, disposable income? Just like that, margin debt as a percentage of market cap is what you should be looking at. And that's the chart you have.
Exactly. Maybe we'll show it right now on the YouTube channel, actually. So David, mark this time down. This is a great chart from our friend Steven Sutmeyer. He worked at Bank of America for a long time, doing his own thing now. And he did just that. Listen, okay, $1 trillion of margin debt. That's a lot. What's it mean? Well, if you, well, apparently, if you, yeah, exactly. You can only imagine what I was about to say. So no, don't want to get fired today. Anyway, all right. With that, look at it as a percent of the overall market cap. All right. And if you do that, this is what we're sharing right now on the YouTube channel, thanks to Mr. Sutmeyer. That's about 16%. So margin debt, 16% of the overall Wilshire 5000, like the U.S. stock market. It was substantially higher back in 2000, 2007, 2021 during the meme stock craze. The reality, again, is that is just okay. I mean, it's opposite of what it might make you think. Margin debt is not as crazy as it sounds. Also, just plain and simple, when margin debt breaks out to new highs and stocks break out to new highs, they tend to confirm each other. You look back in history, Sonu, margin debt actually kind of rolls over before the stock markets. If you're bullish, you kind of want margin debt to continue to go higher with the stock market. Also, one more thing, year over year is really important. That's about 24%. Might sound like a lot, but we saw a lot more, like 80%, 60% at previous major peaks. So again, this is just something we're going to push back on. Margin debt is quote unquote high, but when you peel back that onion, it is not nearly the worry that so many make it sound like. And the third, what is my third worry, Sonu?
Portfolio flows. So bonds and equity investments from abroad.
Yeah, we were told, I think we were promised maybe by some people, during the trade war when things were really bad, China's going to dump all of our debt. Other countries are going to dump our debt. Yeah. Nobody trusts us because, well, the dollar's weak. So nobody wants to own the dollar. Our assets are in trouble. But there is that data from the Treasury that I believe it's called the TIC, T-I-C. Yep. I forget what it stands for by chance? I always forget. Treasury.
I should know, but I've forgotten.
Believe me, I don't know it. If you don't know it, I don't feel bad.
Time of the afternoon.
I know, but exactly. But no, this comes out once a month. And Sonu, the numbers came out, a huge surge the last couple of months in U.S. debt owned by foreigners, but also how many stocks and equities foreigners own. Once again, kind of just going opposite of what they tell us and what we're supposed to be seeing, why does that matter when it comes to financing our deficit, though?
And when you say financing a deficit, you're referring to the trade deficit. So that's the deficit.
Good call. We'll put up that chart right now.
So essentially what you see, I think it's a blue line, if I remember right, which is portfolio inflows into basically foreigners buying U.S. stocks.
Yeah.
Right? Versus foreigners buying bonds. Both lines are going up. That means they're continuing to buy U.S. debt, which is mostly Treasury debt, and U.S. stocks, right?
Yep.
Now you think about, this is a very important macro concept. I don't think it's talked about enough. If more money is coming in from abroad, like what do foreigners need to buy U.S. stocks and U.S. debt? Well, they need dollars.
Yeah.
Now, where do they get dollars from? They get it from us, right? Now, what do we get in exchange? Now, you could say we get euros and yuan and Brazilian real. Actually, we don't. Instead, we get TVs and computers
I was
and
going to say
iPhones.
wine and cheese, for
wine
France.
and cheese.
This is called au revoir to the trade war. So
a few Mercedeses, Porsches, Ferraris, whatever, right? You get all this stuff from abroad, and we give them dollars. What do they do with the dollars? They invest it. And now historically, what's happened is that, from the 2000s, that's when the U.S. trade deficit started to blow up, right? Started to increase a lot. And the other side of that means there's a lot of capital inflow. So the trade deficit, the opposite of that is a capital surplus. That's just national accounting. It just has to work like that. It matches, right? So back in the 2000s, up to the mid 2010s, remember at that time, everyone was talking about, oh my God, China owns so much of treasury debt. It's funny how back then it was like, oh, China owns too much. And now it's like, oh, China's dumping too much. Like, make up your mind, right? Pick one. Right? But at that time, they were buying a lot of debt. Why? Because they had a lot of dollars from us, right? But now over the last decade, 2015 to about 2024, 2025, even, we're seeing that this is the blue line in the chart. Most of that money is going to buy U.S. stocks. Why? Because we have the best companies in the world. Look at the technology industry. Everyone wants a piece of that. And that's essentially what is, quote unquote, funding the trade deficit.
Yeah. Well said. That's another myth we're hearing. And there was something you wanted to build on this. Well, which angle do you want to go with this?
Trade war. Let's talk about trade.
Let's go straight to the trade war. Okay, I wasn't sure where it was. So, au revoir trade war. Sonu, you did an amazing blog on carsongroup.com/research. And you pretty much said last week that the trade war is over. Now we came in on Monday, and U.S. and the EU apparently have a deal. We've got a deal with Japan. We've got a deal, or we punted on China another 90 days, but apparently we're close. Who else? What other ones were? There's the UK was the first one. Indonesia. I think one more.
Vietnam or Philippines or Vietnam.
You're
no
right.
offense to any Filipinos, Vietnamese.
Well, this podcast is listed in like 110 countries or something,
including a few from Singapore.
Exactly. There's a good chance that
hello to our friends in Singapore.
Exactly. But the reality is, when you looked at it and you thought about it a little bit, trade war's over. Talk to us about that.
I think, look, the reality is everyone wants to move on from the trade chaos.
Yeah.
Other countries.
We don't want to go back to April. That is for sure.
And look, my perspective is we actually dodged a big bullet, a massive bullet, because what happened?
It was Indonesia and the Philippines. That's who it was. They were the ones the same day as Japan. So shout out to our friends all over the globe who listen to this very podcast. Thank you.
It takes two to do this.
There we go. Oh, sometimes more. It takes three. We have David. We know what we're talking about half the time. Yeah.
And Maria now.
It's true. Maria, wondering why I sent her something about margin debt. I don't know, Maria. Sorry. Yeah.
Anyway, shout out to her. She's great. She manages. She does all the events and things like that.
She keeps us in line. She's like she's asked for like a month. Sonu and I are supposed to do something for somebody. We're not putting it off. We just forget. She's always like, you two figure this out and get it done. So I don't blame her. She's doing her job. Yeah.
All right. What do we? Okay. Yeah. So going back to April. So what was when we came into this year? What was the status quo? Status quo is we had 25 years of one particular trade regime, right? And by the way, that was good because there's a reason how U.S. companies make a lot of profits is by having supply chains extend across the world. Yes, during COVID, we found out the downside of doing that. But essentially, this is how U.S. companies have made profits and made amazing profits over the last decade, 2 decades, really, right? Because, part of it was the U.S. was running a massive trade deficit. The rest of the world, they were relying on, we'll just make stuff and sell it to the Americans. The Americans are ready to buy it, right? And now Trump comes in and he says, I hate this. I don't like this, right? I'm going to remake the global trading system because we don't want large deficits. Remember, that was the main goal of this whole tariff thing, right? Let's reduce our trade deficits and let's impose massive tariffs to incentivize reshoring. But to be clear, what does that mean? That means you're making foreign goods more expensive so that U.S. businesses and consumers are going to be like, you know what? I'm not buying this stuff from China and Europe anymore. We're just going to make it here and buy American, right? So that was the main goal here. Now, you walk into April, we have these Liberation Day tariffs, and we're like, wait a minute, the administration seems serious about this stuff. I don't think before Liberation Day, anyone was like, yeah, whatever. Nothing. Things are not going to change. They're going to try some deals.
Including us. I mean, we were in that camp too. We were in that camp.
Absolutely. Yeah. Totally. Yeah. Right. I couldn't believe my eyes when I saw the president standing there with a big board. Right?
I couldn't. I can't wait to talk about the president and Jerome Powell. We'll save that till the end because we have to get through the rest of it before we start giggling again.
So he comes in, and for a week it looked like, goodness, these guys want to, remake the global trading system, and
or wreck the economy. I mean, that's what's eventually going to happen too.
Wreck essentially how companies make profits, right? That's essentially, I mean, from our perspective, we're worried about markets, driven by profit growth. We're going to talk about earnings as well. If you break that, yes, companies will eventually figure it out. We have, really adaptable companies, but over the short term, you're going to take a massive hit. Yeah. But then, of course, the bond market, more than the equity market, right? The bond market just threw a complete fit.
Yeah.
And they reversed everything. They absolutely just, you know what, we're not going to do this anymore. And I think what's interesting about, and this gets to why, anytime you're in this business like ours, when you're doing what we do, portfolio management, you always want to pay attention to markets. And I think you had a tweet out about markets sussed out these trade deals back in April.
Yeah.
And I would go even further. I think the market sussed out the fact that, you know what, the administration is done with trying to remake the global trading system. They're not going to do that. We're done. We're moving on, right? Now, it wasn't 100% certainty, but last week, especially after the deal with Japan, I was looking at it, I was like, okay, 15% tariffs, things like that. There is something about the Japanese are going to invest $600 billion into the U.S., but, you look at the Japanese press, they're like, most of that is loans, maybe 1% is an investment. The Japanese government cannot force private companies to do anything. In any case, whatever it is, the other side of it is, if money is coming in, the important part is this. If the Japanese on net are putting money into the United States, it's the same thing, literally what we talked about. Instead of buying U.S. stocks or U.S. bonds, they're investing in U.S. companies. That's foreign direct investment. What's the other side of that? That's a trade deficit. That means the trade deficit remains really high if you're getting in more fixed direct investment, right? Foreign direct investment. It's FDIs. So all in all, I think the status quo remains. Deficits remain high. I don't think there's a lot of reshoring. 15% tariffs are not large enough for American consumers and businesses to say, you know what, it's too expensive. Let me buy American.
So let me jump in. Let me just jump in there for a second. So remember, there was a lot with Apple when all this started, and saying, hey, stop making your phones in China. Apple has earnings. Maybe by the time people listen to this, I mean, they're not changing, right? They're just going to keep making it in China. I mean, they probably told President Trump, listen, that's not happening. I mean,
that's what Dan Ives was talking about, right? Dan Ives was throwing a complete, guys, you cannot do this.
Right. Well, so we'll put up now on the I just want your take on this. We'll put up the Financial Times. It says here, Financial Times, this is right when the EU and the United States had their deal announced. There is no hiding the fact the EU was rolled over by the Trump juggernaut, said one ambassador. So I don't know who that ambassador is, but this is from Financial Times. Trump worked out exactly where our pain threshold is. I mean, did the U.S. win this round versus the EU? I mean, European stocks are going up too. And again, let's be clear. I don't think the Financial Times is a very big fan of President Trump. I don't think the Economist is a very big fan of President Trump. So whatever he does, I don't think we're going to like. But that was interesting. That was their take. Why was that the Financial Times take, you think?
I'm curious about, the sentiment in Europe seems to be that, this is bad for Europe, right? But then I'm looking at this and I'm thinking, wait a minute. Europe still gets to export its wine and cheese and cars and pharmaceuticals. The biggest export to the United States from the EU is actually from Ireland, is the pharmaceuticals. And that's actually pharmaceutical. Okay. And that's because and it's by US Pharma, right? That they're doing profit shifting, things like that. It's just cheaper to manufacture there and sell it here. So that's actually the biggest thing. And then you have, like I said, cars and wine and cheese and chocolates and whatever, right? They still get to do that, right? Yes, there's a 15% tariffs, but we know from the import data that import cost indices that foreign exporters are not paying the price of tariffs. Right. It's American businesses and consumers. I think there's some ambiguity about who exactly on the U.S. side is paying it. Is it businesses or consumers? I think only, the next 2 or 3 months will probably start telling us what's happening there. But essentially what's happened, right? The U.S. government is raising, we talked about last week, about $200 billion extra in tariff revenue.
Right. Mm-hmm. Right. And it was like 40-ish. 40,
yeah.
50,
this is 200 there. Above that 40, right? So 200 extra. So you think about the next 10 years, that's about a $2 trillion, revenue increase for the U.S. government.
Okay.
Basically, what has the administration done? They've enacted a tax without calling it a tax increase, right? Now, we got this big, beautiful bill on the other side. That's $3.4 trillion. So this thing covers about half of that. It's going to be about $4.5 trillion once they make the provisions permanent within those tax cuts that Congress has passed. But, $2 trillion is not nothing. But it's a tax increase, to be clear, right?
Fewer things have ever been more certain on this podcast than saying $2 trillion is not nothing. I agree there. Maybe it's a rounding error to some, not to us. Yeah,
$2 trillion is not. But it is. Let's be clear. It is a tax increase that the administration was able to, take out of consumers and businesses here in the U.S. without calling it a tax increase, because there's no way Republicans would pass a tax increase.
Exactly.
I mean, they used to be the party of free trade as well, but they've got a tax increase basically, and I don't think it's going to reshore businesses because like I said, they're just going to eat the cost, right? The other thing was, the third justification for the tariffs was, we want to level the playing field.
Yep.
Right. We want all these other countries, like whether it's the EU, Japan, to reduce these things called non-tariff barriers, whether it's a VAT tax, technical safety standards, and Airbus subsidies, things like that. But see, the problem for U.S. exporters is not non-tariff barriers. Like, even if you think about Japan's non-tariff barriers, safety standards for vehicles, things like that, European car makers face those same non-tariff barriers. They figure out what to do, right? Okay. In the U.S., it's different. If U.S. automakers have to, export cars to Japan, for one thing, the Japanese don't want the stuff we make. They don't. What do we make most of? SUVs, minivans, light trucks, things like that. Yep. These are less fuel efficient. Gas prices are much more expensive in Japan, even in Europe for that matter, right? And then, the cars here are left-hand drives, right? Whereas in Japan, it's a right-hand drive. So first of all, we'd have to create a factory to create right-hand drives. Nobody's doing that, right? Ultimately, the reality is, anything American companies want to sell abroad, they make that stuff abroad. Think about iPhones. Think about drugs, even cars, right? If you're making, a Ford Fiesta or whatever it is in India or in the EU or Japan, Ford makes it abroad and sells it there. They don't make it here and export it, right? So anyway, all this to say, the trade war is done. The chaos is over. Everyone wants to move past it. Big picture is, I don't think the status quo has changed too much. The U.S. government is generating a ton of revenue, $2 trillion over the next decade. That is, like I said, not nothing, but it's coming from the pockets of consumers and businesses. And I think there is a hangover, right? I think the biggest impact, I've talked about this before, I've been saying this since the beginning of the year, the biggest impact of the trade war is that the Fed pauses on rate cuts.
Yeah, so I'll jump in there. So what do we get out of it, right? I mean, like you said, we got some more revenue, potentially have some better deals, or different countries are opening things up to us and paying potentially money to the United States to do investments. But again, we also have higher interest rates and a Fed that is in a tough spot, right? Is that something else we got out of it?
Yeah, and we got, the scene we saw last week at the Fed building between Trump and Powell, right? And, no, all joking aside, I think, look, the reality is, if you look at U.S. GDP growth, right, we're going to get GDP growth for Q2 this week. But even Q1 was negative, but that was because of exports and things like that. Right. But within GDP growth, what you want to focus on is real demand, right? How much are consumers buying? How much are businesses investing? And how much is the government buying too? I mean, that matters as well, right? And it's mostly state and local governments, which is about 12% of the U.S. economy. Federal government is about 6%, right? That was, in 2023, 2024, that was running at an annualized pace of over 3%. That's why we had near 3% GDP growth over those 2 years. Even before the pandemic, 2010 to 2019, that was running about 2.5%, something like that. Q1, in the first quarter of this year, that slowed to 2%. In the second quarter, looks like it's going to come in around 1%. So basically, real demand has slowed a lot. The economy is slowing. Doesn't mean it's a recession, but the economy is slowing. I think essentially what the economy is feeling, and I don't think this has mostly to do with tariffs. There's some tariff impact. It's mostly interest rates. Interest rates are too high. Interest rates are higher than the pace of wage growth right now. It's pretty much running close to the pace of nominal GDP growth, maybe higher. that means policy is too tight.
Yeah, so we'll talk more about the Fed maybe in a little bit. We'll save that conversation. One thing that struck me was just what you mentioned, that everyone's shocked that we're getting these trade deals done. And listen, I know there's flaws in them. I know they're not official. We get all that, but the reality is they're happening, and the market seemed to have sniffed it out a while ago. Like you said, back in late April. I mean, we were sharing on this very podcast every single week. I was sharing multiple things like this is super rare, up 1.5% 3 days in a row. There's wide breadth thrust, all these different buying thrusts, all these the best month in a long time, best 2 months in a long time. The bottom is in, the bottom is in. We started saying that after, at least I did, after April 21st. April 21st had another big update with a lot, like 95% of the stocks up, 95% of the volume up. On the heels of April 9th, when you have 2 big buying days like that within a 2-week period, the lows are in. And we started saying that on this podcast back then, and I think the market sniffed out likely better times. And I thought it's interesting to go back and remember where we were. Because on May 2nd, here's a tweet that I actually did. Goldman says, it's on May 2nd, okay? So you're off the lows. Now take note. Yeah. In May and June, we just gained like 11% for the greatest 2-month rally in those 2 months ever. And now July, it's almost over, up like another 3%. So this is ballpark a 15% rally since what I'm about to read you.
And May 2nd was before the China tariffs was also suspended, right?
Good point, yeah. So Goldman Sachs markets might not have bottomed. Wells Fargo could retest the lows. Morgan Stanley retested the low end of our 5,000 range is feasible. JP Morgan sees the S&P 500 falling to 4,000 in a worst case scenario. Bank of America sell the rebound in U.S. stocks. Now, I'm not necessarily calling any of them out, although it probably sounds like I am. That's just the reality of what we were being told by a lot of places. And again, that's why with this podcast, we kind of look at the facts, we look at the feelings, we come up with an opinion. We tend to side with the facts a little bit more. We understand feelings matter. But again, those are some things that I think are fascinating, Sonu. Now, the other one, I'm going to put it, David, I just sent it in the team's message there. I saw an article in the Wall Street Journal that just, I don't know, it is what it is. I think it was to maybe get some clicks to a degree. But it says, why are stocks up? ? Nobody knows. And I'm thinking to myself, well, those people aren't listening to our podcast, because we've been listing for a while why stocks are up. It's a global bull market. There's no recession coming. But what I want to turn it to you, earnings, profit margins, valuations, all that stuff continues to suggest this is a justified bull market and rally, in my opinion. You want to talk about earnings so far, Sonu, with this earnings season?
Just one quick thing, right under the headline, why are stocks up? Nobody knows. The sub-headline is a torrent of bad news hasn't been enough to sink the market. And I'm thinking, wait a minute. Okay, yes, we got Liberation Day tariffs, but ever since then, we've actually got good news.
Exactly. Good point.
We've got good news. It's not been bad news. The good news has been, you know what? The administration is pulling back on all this stuff, right? And they don't want, like I said, they don't want to remake the global trading system. And then over the last month, what have we seen? They're more interested in making deals and getting to these deals really quickly, irrespective of what's in it. We can talk about what's in it all day, every day, right? Irrespective of what's in it, the reality is, let's get the deal done. Let's move past this. Everybody, including the U.S., wants that. So I feel like it's all been good news. It's not been bad news.
I tend to agree with you there.
Right?
Well, let's see. So what is it? 34% of companies. I'll say a few things. You jump in. Yeah, 34% of companies have reported as of last Friday in the S&P. Second quarter up 6.4% blended. That is from our friends at FactSet. This time 6 weeks ago, 5%. So better. The big one though is in 2026 earnings expected to be up 13.9%. It was 13.8 about 6 weeks ago. That is really good. I mean, like higher. And you mentioned on a call with our 5% revenue is really solid. 80% of companies beat on revenue and on earnings. So good stuff there. You mentioned 3M. I was just in Minnesota last week. Had a lot of fun. Shout out to Jeremy and the team. Thank you for having me in your great state. That was a blast. 3M earnings are actually higher now than they were at the start of the year, and that's including all the tariff stuff, right?
Yeah, look, shout out to our friend Samuel Rhines from Wisdom Tree, actually.
Yep.
And a fantastic macro strategist. So he had a great note, I think this was last week. So he said that, look, when the tariffs first hit, and that was at extreme levels, right? Companies were like, they started guiding for the worst possible scenario. But now those companies, literally speaking of good news, the companies are saying, wait a minute, things aren't as bad because the tariffs have been eased. And they already set really low expectations. And then there's been a reality on the ground that companies also prepared for the worst. They didn't just say the worst is coming, they prepared for it. And they prepared for it by, making the supply chains a little more efficient, things like that, promotions, pricing action. They raised prices in some areas. And then, wait, what happened? The worst didn't happen, right? So a good example is, actually, I'll get to 3M. Sam points out that Johnson & Johnson, during their first quarter conference call, by the way, none of this is a recommendation to buy any of these stocks and all of that, right? During Johnson & Johnson's first quarter conference call, this is back in January, they said the impact from tariffs in 2025 is going to be about $400 million. Now, they anticipate the impact. There's still an impact. They anticipate the impact to be $200 million. That's a 50% drop in the tariff impact for the company. You tell me, is that good news or bad news?
Good news.
Right. So, then you get to 3M, right? So initially they said, okay, the tariff impact is about 20 to 40 cents a share. But then in their latest presentation, it was on July 18th when they did their earnings call, they guided that impact down to 10 cents a share. And here's the thing, they ended up guiding their EPS even higher than their pre-tariff expectation back in January.
Right.
So basically what's happening, 3M is expecting a fairly largish impact from tariffs. It's not as bad as they thought in April, but they prepared for it. But because of that, they're now able to guide profits even higher than they did back in January before all this tariff stuff happened.
And people are asking why stocks are higher.
Can I quantify that really quick? I'll that chart I prepare where I break down the S&P 500's returns into how much comes from multiple expansion, how much comes from earnings growth, how much comes from dividends. As of last Friday, July 25th, the S&P 500 is up 9.4%. It's probably the same thing right now. 9.4%.
I think it is.
5.5 percentage points have come from earnings growth and dividends. Only 4 percentage points have come from multiple expansion. So literally quantifying this, why are stocks up? Well, because earnings are up.
Yeah. And listen, in a bull market, you get a little more confidence. You can have multiples go higher. It's not the end of the world. And that's what we've been seeing. I will share this one right now, David, about the 20-day moving average on the S&P. The S&P 500 recently is above its 20-day moving average for 3 months in a row. That's really rare. And you never really know what's going to be popular on social media. I did this one last week and it went viral. But I looked at all the times the S&P was up 60 days above the 20-day moving average. Let's just take note that 20-day moving average is a short-term trend line. Usually, I don't know, every week or two, you're going to cross above and below it. You kind of hang out around it. So the fact we've gone 3 months above it right by itself is extremely rare. Sonu, I took a look again. When you start the clock, it's 60 days above the 20-day moving average, which has been last week. 3 months later, as you can see on the YouTube channel, higher every single time with 5% average return compared to the at any time 3-month return of 2.2%. Then you look at the last 50 years, happened 4 times the last 50 years. And looking at those times, a year later, S&P 500 is up every time between high 19% and about 26%. So the reality is this strength we've seen, this might sound like a broken record, the strength we've seen off these lows is not consistent with the bear market rally or one that's going to roll back over. It's consistent with actually, kind of a new bullish phase. Now, listen, we're up well over 26, 27, 28% off the lows. So we've had a heck of a start. But these are little bullet points that continue, I think, at least for me, to suggest that something's happening here. The macro backdrop is, okay, not perfect, but the technical and the sentiment backdrop continues to be really strong. Speaking of sentiment, so there was who was it? Gallup poll. There's a Gallup poll that came out. Now, I'll be clear. I don't really know who answers Gallup poll. I'll admit, I don't know. I think it's just regular people.
Have you ever got a call from BL?
No, I can't. I would love to. I wish I could. I get enough junk calls, though. But the Gallup poll, they said 6 out of 10 Americans that were polled in this is just recent. Are worried about the market and volatility in the future. 88% of all Democrats think the worst is yet to come. Republicans, let's be honest, we're probably thinking that a couple of years ago. But it's so political. But for 6 out of 10 people to be really worried about the future and talk about all this volatility. So we haven't had a 1% up or down day in over a month. That's like a historic run without any volatility. We literally aren't having any volatility. The VIX, I don't know, wherever it is, sub 15. I mean, it's not, nothing's happening. And yet people are worried about volatility. That contrarian in me, when I hear stuff like that, I'm sorry, I'm going to keep taking the other side of it. To this bull market, we the bulls in the AAAII down 4 weeks in a row. The name in AAIM, we talked about it last week, is down, I think, three weeks in a row. I think there's a couple other, but we'll just stick with those. But we've got a market that's making new highs, feels like every day. Yep, people aren't excited. I'm not hearing from people. I know in 2021, it got a little squirrely out there, a little crazy. Yes, meme stocks and GameStop and this and that. But I'm simply not hearing anything. You hearing anything from anybody out there?
No, nothing's happening except the market's going up.
Yeah, which is beautiful. Beautiful. Yeah.
I think, look, I'm a macro guy, so obviously I follow the macro news. But there is something to be said about getting too macro pilled.
Yeah.
That's a word for it. Like
it is now.
Yeah. You look at all the news, like I just mentioned, GDP growth and some weakness there. But remember, that's not a recession, right? By the way, the economy can grow below trend for a decade, which is literally what happened over the last decade.
Oh, yeah. Stocks
and
are
the
just
stock
fine.
market did totally fine, right? Average, 10 to 15%, something like that per year over a decade, right? But this time it's like we goes back to what we were just talking about. It's coming on the back of earnings growth. You look at 2025 EPS, right? At the end of June, it was about $263 per share for the S&P 500.
Okay.
Right now, it's actually it was $262 a share. Now it's $263. Okay. Not a big increase, but it's going in the right direction.
Sure.
But more important, I think, for now, especially for next 12-month EPS, it's 2026 EPS, right, for the S&P 500. At the end of June, it was $298 a share.
Okay.
It's now about $300 a share. That's more than like a little over 0.5% increase. But here's the thing: for the next 12 months, right, EPS growth has continued to increase, and that's because that 2026 EPS is going up and up and up. I will put up the chart, right? And then if you think about what our earnings made of, it's made up of sales growth and profit margins. Forward-looking profit margins also increasing, and that gets to what we talked about with respect to the adaptability of American companies, right? Including adaptability to all this tariff chaos. And I think companies are coming out of that looking pretty good.
Yeah, no, I think so too. And I mean, listen, we can talk and think about this stuff. The market is the one that matters, right? What's the market telling us? The message of the market. I mean, it's been bullish for a while. And I don't think anything has really changed from that point of view. One other interesting one, the time we're doing this, S&P's up ballpark 9% on the year. Some concepts we've talked before about. I think it's really interesting. Only 4 times in history, going back to the last 75 years, has the stock market closed the year up between 8 and 10%. So about an average year. 22 times you're up 20%, 21 times you're negative. So the odds of a 20% gain are higher than a negative year. I know that sounds crazy when you think about it, but it's how it is. What's that tell us? Well, there's pretty big standard deviations and you get some big swings. So the question we have to ask ourselves right now, do we just stay flat right here? Do we just have an average year? Listen, at things we've laid out, we would say no, right? We think the likelihood is we'll have a above average yearly returns. We said in our outlook a couple weeks ago between 12 and 15% total return on the S&P. Hey, you know what? I could live with being wrong there if it's a little bit higher than that. So we do think there's still some upside. Let's see. So Sonu, let's take a second here. Then we'll talk a little Trump and wrap this thing up. Trump and Powell. I watched Happy Gilmore 2 last night. Have you seen that, or did you watch Happy Gilmore 1?
It's on my list since you told me about the movie, and I haven't seen it yet. I need to. Now that part 2 has come out, maybe I should just binge on 2.
Well, like so many times you have to tell yourself the original's better, but I liked 2, and I won't give too much away.
It's not part 2. It's a remake, huh?
What's part 2? That's part 2. It's 30 years later.
Okay.
It's 30 years later. He's Happy's had some hard times. He's fallen on some hard times. He's given up golf, but you can imagine he picks up the golf club one more time. And the reviews weren't real good. I thought it was pretty good. I liked it. I don't know. I laughed. It's moronic humor.
You made a family thing out of it, right?
Yeah. Everyone watched. The whole family watched. The kids and everybody, and they liked it. Yeah. Anyway, but yeah, so Happy Gilmore 2. I thought it was pretty good out there. Let us know what you think.
Nice.
Facts versus feelings, facts vs feelings. CarsonGroup.com is our email, so you can let us know there. Anything else you want to talk about before we finish it up with the Fed and that very awkward conversation last week?
Let's
I want to go there. So last week, I guess it was Thursday. I'll set it up. Let me see. I've got this stuff somewhere. I wrote it all down. It was really smart what I wrote down. Where did I even put it? It was only the fourth time since 1937 a sitting president had gone to the. Here it is. Yeah. So President Trump visited with Powell in the Fed building. It's called the Eccles building?
Mariner Eccles.
Mariner Eccles. So it's named after Mariner Eccles.
My favorite Fed chair.
Sonu's favorite Fed chair. I didn't even know that. You learn something new every day there. But the last time a sitting president visited this building was President Bush in 2006 when they swore in Bernanke, which kind of makes sense. This is only the fourth time since 1937. All right. A president has come into the Fed building. My comment earlier this morning was, why don't they just walk by once a year? Just say hi. It's in Washington. You're kind of walking the dog. You're out there. Maybe, you know what? Hey, I might as well go see the Fed. But as you pointed out, they are supposed to be separate. So maybe that's technically, but there are some articles of, literally presidents like having shoving matches with Fed chairmen. You can Google it, you can find it. But so this is, Trump's obviously really rough on Powell, but at the same time, well, he's not the first guy to do this, but they had one of the more awkward conversations we've ever seen. It felt like straight out of The Office. We talked a lot about their relationship, I guess we'll say, last week, but talk to me about what happened. Well, what in the world happened with the piece of paper? And I don't even know. You watched it on a loop for about 6 days straight, or it hadn't even been 6 days, 3 days straight. Yeah,
you watched it 1,000 times. 200, 500 times. So it's so funny. Look, going back to, we were talking about this back in May, can Trump fire Powell? Right? And everyone at the time was, no, he can't fire Powell. But I was like, he can for cause. Mm-hmm. Now, what the cause is, who knows, right? But now it looks like they found cause. I'm not saying they will. I think on balance, they're probably high odds that he fires Powell, especially if they don't drop interest rates in July, which is next week, or even in September, right? And so, with respect to finding cause, the thing is, they've, come across this charge that the Fed building renovations have massive cost overruns to the tune of like $2.7 billion. I don't know what it was originally supposed to be, but remember, these are historic buildings, and apparently they found out that the whole thing is built on a swamp, and they have to redo it, and So anyway, Trump was like, obviously, he has to make. Wait,
are you calling Washington a swamp? Of course, there's built on the whole place is a swamp. Isn't that the whole saying? I don't know.
No, literally and metaphorically.
A swamp. Okay,
it was literally a swamp too, I believe. Yeah, and metaphorically.
Yeah, drain the swamp.
Yeah, drain the swamp. So I guess they had to drain the swamp, and draining the swamp under the Fed building
cost a couple $1 billion.
Crack myself. So obviously, the president, being who he is, has to make a spectacle of it. And, he's no stranger to this thing. He's like, I'm going to go visit the Fed. Now, what was interesting is like, when I saw the news, like, oh, okay, he's going to visit it and, whatever. He's going to do what he does and come out. Then I saw the news like, oh, Powell's going to accompany him. I was like, this is getting interesting.
Wearing their hard hats. Yeah.
So I come out and standing together. Trump says, there are cost overruns. He pulls up, and then he says the cost overruns actually $3.1 billion. And Powell's like, well, that's not true.
Yeah, his face.
And it's almost like Trump was really prepared for that, right?
Oh, yeah.
Like, how often do you expect the president to carry like a letter from wherever in his side pocket? But he pulls it out. He said, no, look, it's right here, $3.1 billion, right? He shows it to Powell. Powell takes his glasses out, very seriously looks at it. And he's like,
so awkward.
He's like, that's not true. Wait, you're including the Martin building. And he's like, yeah, but that's included. You're renovating that. He's like, that was done 5 years ago. Sorry. I mean, it was funny.
And I lived in South Carolina for a long time. So Tim Scott, he was there too. He kind of chimed in a little bit. It was I mean, it really felt like The Office, if you remember that show at all. Just these awkward moments of like, oh my goodness, they're really going there. Man. So, yeah, I joked after that, they need to have like a reality show, and we just need to follow those two guys around, and because they're both going to try to backstab the other one every chance they get, and it just would be amazing.
But so, I'll just add this final thing. If you looked at Powell during that whole thing, he doesn't look like somebody who's going to resign. I know Professor Siegel has called for his resignation. Jeremy Siegel has been on the podcast several times, and Mohammed Alarian has also called.
He said it.
Yeah, I'm a little skeptical about why these guys are calling for his resignation, but still,
there's an angle. There's an angle.
Powell's not going anywhere. I think that's the bottom line here. From what I saw with that whole dynamic between him and President Trump, he's not going anywhere.
So, again, let's wrap this up now. This week, by the time a lot of people listen to this, the Fed meeting will have happened. We don't anticipate any rate cuts. Maybe they're setting the stage for September. We'll see. But I will say what's interesting is Bowman or Bowman? You think I know which one is it?
I'm going to say Bowman.
Fed Governor Bowman and Fed Governor Waller. We can say I know how to pronounce Waller. They've come out and said we think we should be cutting. That doesn't mean they're going to kind of vote that way, but we might have two dissents. And if we have two dissents, Sonu, that'd be the first time since December '93 with Alan Greenspan when Wayne Angel and Lawrence Lindsay both did that. There was one time there were three dissents in the early '90s. But again, those two back then, late 93, opposed the loose policy. The reality, though, is it's not normal, okay, to get dissents, let alone two of them.
At least not in the last 20 years, right?
Yeah, that's what I meant to say. The last, well, I mean, geez, since 93. So what is it, 30-something years?
30 years, yeah.
Yeah, I mean, so it's we'll see. But again, with Trump on one side and dissensions over here, I mean, he's not going to do it because he's being pressured into it. He's being very clear there. You and I have been pretty blunt. Back earlier this year, they should have been cutting earlier this year. We've talked enough about it. I don't need to say it anymore, but I don't know. What do you think? I mean, they're not going to do anything. They're going to set the stage up for September. What's going to happen here?
They're not going to do anything. I think they're going to say, you know what, we're going to wait for more data. And I honestly think that's because they want more data. August CPI is going to be
he's messing with Trump at this point. I don't buy it. He's just messing with him. Yeah.
August CPI, the September CPI, because August CPI will be, technically it's July's inflation data. They're going to wait for July and August to see, because we already started seeing some pass-through effects of tariff impacts in the inflation data. But of course, there's been other big disinflationary forces. We talked about shelter, but also cyclical stuff like airfares and hotels, right? Mm-hmm. And that tells you that demand is weaker on that side. That's why prices are going down. Do we continue seeing that in, for July and August data? We don't know yet. And I think the Fed's going to wait for that. So I am not ready to say that. I don't know that they'll cut in September. I think it's a 50-50 bet right now.
Right. And the futures are much higher than 50-50. What is it, 80% or something? Or I don't know exactly. Well, it's higher. You can look it up in a second there. I mean, you can look it up, but it's definitely higher. We've seen this before, though, where this has been pushed back. So, I don't have too many other final comments. It's a very busy week. A lot of macro data coming out, a lot of earnings coming out. We have the jobs number on Friday. We'll have plenty of things to discuss. We have a special guest. We won't say quite who's coming on. I think it's in 2 weeks. I think in 2 weeks we've got him. Maybe we'll just say this, market technician. We'll just give that away. A market technician, because Sonu's taking a vacation. And let's not forget, last August, Sonu took vacation and the whole world went crazy on the yen carry trade. So Sonu, I hope that we don't get jinxed again with that.
Fingers crossed. By the way, 64% probability that the market's putting on a September rate cut. Maybe 65%.
Lower than I thought it was.
That's not too, that's pretty close to a 50-50 bet. I mean, within one day, if you get some data, you could see that go all the way to 80% to 75%, or come down to 50%. Right?
I mean, by Wednesday, we might have something, depending on the Q&A session, how Powell paints things. All right, any final comments from you, Sonu? Then I'll bring us home.
I don't know. Are you planning to renovate your house? No, I was kidding.
Walk around with my hard hat. They did.
Ooh, I got an idea for the next video we do together.
Oh, there you go. Yeah.
All right. Now, I think the market has momentum right now. Don't underestimate momentum. Like, I'm a macro person. I look at a lot of macroeconomic data and all of it. But if I had to pick one thing to look at for markets, look at, are prices going up? Or are they going down? If they're going up, it's more likely to continue going up.
Mm-hmm. Yeah. Very easy way to put it. So you took the technical side. I'll take the fundamental side. Initial claims down 6 weeks in a row. Okay, we'll get some real-time data there. So again, we now have the comments turned on the YouTube channel, and a few people literally said, here's a comment, you asked for it. I thought that was hilarious, by the way. We don't care. We just like comments because the algorithm likes comments. So feel free and go on the YouTube channel and say whatever you want to us there. And also remember to hear the latest from us, don't forget to subscribe to our podcast. You can also leave a review. Those reviews help a lot. Also had a lot of those. We love your feedback. And the last 3 weeks, we've hit literally the 3 most downloaded episodes of this very podcast we've ever done. Of course, a lot of that is thanks to our friends Josh Brown and Michael Baddick of Ritholtz for having on their podcast. But so a lot of new listeners. Hopefully, we haven't lost them all yet. But it means a lot. We have a lot of fun doing this. We will keep doing these podcasts. It means a lot. Sonu and I. So many people tune in, listen to us. There's a lot of other places you can get your take on Happy Gilmore 2 or whatever else it is we talk about. And we appreciate that you come to us. And thanks to David, our producer, with all that. Sonu, I am coming to Chicago tomorrow. So
all right.
I will see you. Sonu's got me, we're going on a date. We got a couple dates. He's taking me a couple places tomorrow. So we're gonna have some fun in Chicago. I've got a client event, which will be a lot of fun. Get to see Carson Welch Chicago. So shout out to them. You're going to Indianapolis to hang out with. Who you hanging out with in Indianapolis? Who you seeing?
Our friends at Wealth Care Partners.
Wealth Care Partners. Yep. So we're doing a little working during the day and maybe a little fun in the evening. That's how we do it. So listen, everybody, thanks for listening. We'll be back as always next week. Enjoy we're in the home stretch, and some schools actually start really early, for school. So it depends on summertime here. Hopefully, you get one more little quick vacation in there. And it's all. We didn't even talk about August. That's good. We'll save the stuff about August. There's something else to talk about. How August can be volatile. Blah blah blah. We'll talk about that next week. Just hold that thought. See you right next week. Thank you. Take care. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.